Hey guys, it's the coach in the building, your financial strategist, Darvin Moore. And today's lesson is on credit cards versus loans. How do they affect your credit score? Which is the best way to go? Why, when, and how? All right, so I hope this is going to be valuable for you all. So let's go ahead and get started. So listen, guys, there's a big difference between credit cards and loans. Some of you may already know, and some of you may not. But first off, I want you to understand that a credit card is a revolving account. It goes in the revolving section. Somebody say revolving. What does that mean? Revolving really means that, of course, you're going to be paying it every 30 days, and the amount that you owe is based on the amount that you use. So your monthly, the monthly amount that's owed is going to change based on how much you owe. So if you got a $10,000 credit card and you're only using $100, your payment might only be $10 or $20 or $30, the minimum payment. But if you're using $1,000, then maybe that payment may be $60 or $70. So it's based on how much you're utilizing. Okay. Now on a loan, it's fixed. So home loan, student loan, car loan, of course, we know that it's the same exact payment, right, guys, every single month until that whole account is paid in full. Okay, so that's the difference between revolving and fixed, which is really should be called an installment account. Okay, guys, fixed is really an installment account. It's the same exact amount monthly. Okay, now with credit cards versus loans, credit cards affect your scores now, meaning that if you utilize too much of your credit on the credit cards, your scores start to diminish. But on loans, it's a limited effect on your credit score because you can go get a $40,000, $50,000, $60,000 loan, $100,000 loan, and it does not even have an effect on your score. It only affects only if you're late, and that applies to anything. But if you have, let's say for instance, that you go and get a $10,000 credit card, it's the only credit card you got on your credit report, and then you go off and get a $10,000 loan, right? A different person. One got a $10,000 credit card, one got a $10,000 loan. Let's say at the time that they got these things, that both of their scores were 750, okay? For the sake of the story. Now, the person that got the 10K loan, his score is going to stay at 750. The one that got the 10K credit card, his scores are going to stay at the 750. But as soon as that person that got that 10K credit card starts using more than 10%, the score starts to go down, okay? So this is what we have to figure out. So a lot of times with clients, if they need money now to utilize for an investment or something like that, then I don't go after revolving accounts or credit cards, because if I get that for them or they get that for themselves and they use it, their scores get lower, right? Which does what? Which keeps them out of the game for later. Maybe in 4, 5, 6 months, they may want to go get more money because they have other ideas, but they can't get any more money because they used it all. They used all of the money, which made their scores drop, so they can't get any more, okay? But the person that has the loan, they are able to use all of the money and it's not affecting their overall score, okay? So I hope that makes sense, guys. This is very key information for you to understand, because a lot of people, they get the credit cards and they use them all, and now they're locked out of the game. Okay, so that's very important to understand. Now, another thing about the credit card is it's an open line. What does that mean? That means if you got a 10K credit card, you use 6,000 or 7,000. You pay the 6,000 or 7,000 back. You still got the whole 10K that you can use again. So it's open, right? You can use it, you pay it. Now you can use it again, right? So it's an open line. A credit card really is just a line of credit in a different form. Okay. Now, where the loan is not open, you get a 10K loan, as you're paying it, you can't go back in and use that money. Okay, that's very simple, guys, okay? Now, number 4, with credit cards, you can do a credit limit increase, okay? So a lot of my clients, what we do is we strategically make sure that we, every 3, 6, 9 months, depending on which bank or which company it is, we ask for credit limit increases. Now remember, some credit limit increases require a hard pull. I don't recommend those. I recommend, doing credit limit increases in a strategic manner with companies that do soft pulls so it doesn't affect your score. So remember, to get the credit limit increase, guys, what you have to do is just, show utilization, show usage on that card. If you're going to the grocery stores, if you're going to get gas, like your daily activities that you're doing, just go ahead and use the credit card and pay it out of your account weekly or monthly or however, okay, so that you can get the credit for it. And a lot of companies will automatically give you credit limit increases. So I love that aspect about credit cards. But of course, with loans, you don't get any credit limit increases, okay, because it's fixed, right? It's at that certain spot. Now, also with credit cards, normally the limits range from $200 to $50,000, okay? Depending on, how good your credibility is, depending on your income, okay? Now, with loans, normally between $200 and $2 million. So the great thing about loans, man, is that you're able to get higher limits so that you can do more things, okay? Now remember, with the loans, they don't affect your score much, okay? But remember too, guys, that you have to start paying on that loan in 30 days at full amount. So if you got a $20K loan, you have to start paying interest on $20K in 30 days, okay? Which is, with the credit card, if you got a $20K credit card, you're not paying any interest until you use it. And if you're only using $1,000, you're only paying interest on that $1,000. So with loans, guys, I said this before, I really only recommend loans if you have a place for it to go, the money to go, and that money is paying for that debt service. Meaning, if you go get a $20K loan and your monthly payment, say for the sake of the story, is $500, then you should be that $500 that you're paying a month. You're supposed to take that $20K, and that $20K should be making you more than $500 a month. Otherwise, I don't recommend that you get that loan, okay? Unless it's going somewhere that's going to pay the debt service and make you a profit. Now, with credit cards, one thing is it's indefinite. You have it forever, really. They don't cancel it unless you do something crazy, right? So it's really indefinite. It's a line that you have as long as you take care of it, okay, unless the company shuts down or something crazy happens. But hopefully you're going to have multiple cards, so you won't have that problem if one gets shut down that you don't have access anymore. Now, with loans, normally loans last 3 months up to 30 years. We've seen, of course, home loans up to 30 years. So that's the difference between the credit cards and the loans in reference to the time, okay? And so another great thing about credit cards is AUs, right? It says AUs and profit. AUs means authorized users. So the great thing is, if you got people in your family that you want to help out, that you want to help increase their credit, you can add them to your card as an authorized user. Also, if you wanted to give them a card to use, you can do that as well. I don't recommend that, but you have that flexibility, okay? Also, with authorized users, the great thing about it is that you can actually make money helping other people by adding them to your card. Like I said, you don't let them use the card, but what you can do is you can call your credit card company, look on the back of the card, you call them and say, hey, I would like to add my son to this credit card. And that helps your son's credit score. Or you can say, hey, I would like to add this person to the credit card. It could be a family member, it could be a friend, and that family member or friend could pay you for adding them to the card. Why would they pay you? Because it's going to help increase their scores, which gets them access to money. It also helps them with lower rates, because the higher the score, the lower the interest rate, right? So if you're going out to buy a home and you can have a difference in interest rate of 1 or 2% because the scores are different, right? Adding an authorized user can increase the scores up to 100 points, I've seen, okay? Depending on where you at and what else is on the credit report. So better credit, a higher score means lower interest. So a lot of people would love to be added to a card so they can have a better score, lower interest, and access. And so that just makes sense, right? So you can actually make a profit from credit cards. I have people that's on my team that actually adds 3 or 4 people a month to their credit cards, and they're making over $1,000 a month just by doing that. Okay, so that's just an awesome perk to have if you have credit card. Of course, with loans, you can't add anybody to a loan. Normally with a loan, when you do it, everything is signed and sealed. Unless when you initially do the loan, you do a joint account, and then that means it's just two people on that account, right? You ever had a co-signer for a car or things like that? So from that aspect, that's the only way you can get more than one person on here on the loan, but you have to do that initially when you first apply for that loan. Okay, now lastly, on credit cards, you get rewards. Oh my God. So guys, listen, you get to fly and travel for free. Today I'm doing this course in Colombia, right? And my travel was free. My flight was free. Okay, so guys, you get cash back on gas and all different types of things. Look at the credit cards, see what type of offers they have and rewards they have. See if it fits you, and if it does, go for it. Loans, of course, there's no rewards on the loans. I think the biggest reward in the loan aspect is that it does not affect your score as much. Okay, it doesn't affect your score really at all when you use it. But with credit cards, as soon as you use over 10%, it affects. The other great thing about loans is that you get more money. So if you got a great idea and you really need this more money, then loans make sense as well. Okay, guys, so I just want to clear up the difference between credit cards versus loans on your credit, because this helps you figure out the strategy and which way to go and how. All right, guys, listen. I hope this all makes sense for you. I hope you educate your family and your friends on this, because it's very important. I'm your credit specialist, your credit strategist, Darvin Moore, and I'm out.